Welcome to episode 244 of The Numbers Game. I'm Jace. I'm here with Nick and Marty. And guys, today I wanted to kick into an episode that was around spotting trouble before it's too late. Financial red flags. What do you think, guys?
Mate, I'm all ears because if there's trouble to be made, you're the man to do it. From what I've seen on social, so you just keep doing what you're doing because it's certainly exciting.
Look, I want to make this as punchy and efficient in a sense. Like this is what you need to know. If you're in business or you've got friends or family in business, these are the things that you need to start listening out for and kind of paying attention to. And the reason I bring this up is I've been doing this for a while and I have such a care for small business owners and their success. But more than ever in my career right now, I am seeing not just, in my own business, but I deal in the CPA. I'm on the Victorian Public Practice Committee. I'm the chair of the committee. I do some work with Xero as in Xero's Partner Advisory Council, and I'm quite well connected to a lot of accounting firm owners. And there has never been more of a time where we're facing voluntary administrations, liquidations, small business restructures. These are all insolvency events where businesses are shutting down, they are liquidating. The ATO is sending out more director penalty notices than I've ever seen in my life. When you think about it as well, the ATO debt is at 110 billion or more, up from roughly 54 billion a few years ago. So the ATO's debt book has doubled in the last couple of years. It is monstrous, which means they have ramped up their debt collection, and the flow-on effect is that businesses are in trouble. So I wanted to talk through the financial red flags that we see at Future Advisory when we go through clients' books, and also the ways that you can look out for it in your family, friends, and your own business. So,
Jace, are you finding that directly in the accountancy industry as well? Like from what you hear internally and is it smaller groups? Is it larger groups?
Oh, so no, accountants are fine. We are under the pump. We've got, lots of business. People are coming to accountants. If anything, it's that accountants are drowning in work that is compliance and compliance driven. Accountants are probably struggling to get to the advisory work, which helps small business owners turn it around. And that is why, you see the growth of like business coaches and, financial advisors and those kind of things outside of the traditional accounting space when it comes to small business advice or advice on how to grow or take control of your business. Accountants, I'd say generally, a lot of accountants are too busy doing the lodgements and the compliance and the BASs and the tax returns to stop and take a step back and go holistically, is this business okay? Are their margins right? Are they hitting benchmarks? And how can I help them be more profitable?
So, yeah, okay.
So basically, red flag number one, if you have credit card debt and your overdraft is always maxed out. So that is red flag number one. If month to month you're paying off your credit card just to then add more debt to your credit card again, and you're never knocking down that balance. You think about your credit cards are usually 18 to 22%. That's about what you guys would think for credit card interest rates?
Yep, around that.
Yep. You got 18 to 22% on credit cards. You've got the average overdraft. Maybe it's a good secured one at 8 or 9%. I'm not the finance guy. You've got unsecured overdraft at as high as that as well, 16, 17%, or maybe not as high.
Sit around 14, 15.
14%. Cool. That's why we've got the finance experts on the podcast. So you've got maxed out overdrafts, you've got maxed out credit cards, and month in, month out, all you were doing is knocking them down to max them out again. These are long-term problems with high interest rates, high interest debt. This is not a solution to be able to run a business, and that is why it is financial red flag number one.
Yeah, that's a great point. Hardcore debt is a big issue in the small business sector, and that's one of the things to clean up. Everyone thinks about generating more revenue, but really, I think when I listen to you speak, the fundamentals of trying to create 3 months of expenses covered in cash is really important. A lot of business owners don't think about that because things can change pretty dramatically in business. And if you've got 3 months of cash flow cover, you generally got 12 months of cover because you're going to be generating revenues, right? But the other thing, once you've got that, anything that's over 6.5% that's not good debt in relation to an asset, you've really got to try and squash as quickly as possible. Like, I don't mind if business owners have an overdraft, I don't even care if it's 20%, right, to be blatantly honest, as long as it's not a hardcore debt. If they're just going back into credit and they've got it there as a backup, that is understandable. But when it's hardcore debt and they're not moving that debt, that is a falling knife right there. That's a real problem.
Yep, 100%. Now, some of the ways to fix this, if this is you, you've gone, well, you know what, I pay off my credit card just to max it out again, or my overdraft is always pretty extended. You need to get a proper cash flow forecast. That's definitely step one. You need to understand what is happening with your money. So actually reviewing cash versus what your profit and loss says or what your balance sheet says, just having a cash flow forecast. Money in, money out.
Do people particularly in the first 3 or 4 years of business, do people even know their break-even point? You know what I mean? I think people don't even understand their fixed expenses and what they need to do as a minimum to break even, let alone carry, the debt position. It's quite bizarre. When you're on the ground with it, it's quite scary what you see.
I'd go deeper than that, mate, and say, do people actually understand their responsibility as a director?
It's a great point.
Great point. You can talk small business where it might be a 1 or 2 person band, but if you're a director with staff, with super liabilities that need to be paid, tax. There's legislation on the responsibility as a director, and if you don't understand the stuff that Jace is talking about, then you're probably not fit to be a director. So it probably needs to start there. Yeah. Do you know what you're required to do as a director that's running a business? And if you don't, you need to go and learn really quickly. Or go, team up with someone like Jace.
Yeah. Stay tuned for the Numbers Game business education platform to hit late 2025. I reckon we'll get this up and running because nobody else is doing you can become a director, you can get an ABN, but there is no course or education that you have to do before you can go and start a business or become a director.
And people are generally good at a skill, aren't they, Jace? But not necessarily always great at expanding that into a business. So,
spot on. And obviously we feel pretty strongly about that. So obviously beyond the credit cards and maxed out overdraft, I mean, that's where talking to a team like Innovate, and this is not generally plugged, but when we send clients over, when they are in debt or credit cards or overdraft facilities, there's generally a better solution. And it does come with having to do the hard yards of the cash flow forecast, review your pricing, look at break even. But at the end of the day, if you can refinance into a cheaper facility and see a runway or a light at the end of the tunnel and sharpen up your pricing, sharpen up your expenses, you get that peace of mind that you are then have an account built up for emergency. As you said, Marty, 3 months worth of expenses and not relying on the credit cards.
It's like personal budgeting, isn't it? You should be reviewing your mortgage. You're seeing you get a better rate. You should be reviewing your energy bills. And it's the same in business. You should be doing that once a quarter and just optimizing, really. It's healthy.
No, 100%. Financial red flag number 2, Nick, you kind of touched on it a little bit just before, late super payments, the obligation to pay superannuation. So it leads on to when you're not managing your cash flow. Obviously, a lot of cash flow problems go hand in hand with credit card debt and overdrafts, but superannuation payments are a big, serious one. The reason I say that is as soon as your superannuation is late, it is no longer tax deductible. So even if you pay it after the due date, it's going to sit in your profit and loss and make it look like you've made less profit, but that'll get added back at tax time, giving you a bigger tax bill. Beyond that as well, you also then need to lodge what's called a super guarantee charge form. It's your way of putting your hand up to the ATO saying, hey, ATO, I owed 20 grand of superannuation. I paid it late. Either you've paid it and you're just admitting to the ATO you paid it late. They'll then give you a GIC or interest charged on that late payment and an admin fee for each of the employees that were paid late. The alternative is if you haven't managed to pay it yet, it is your way of admitting to the ATO that you still owe overdue superannuation. They then move that into a separate account with the ATO and you will make the payments to the ATO for that overdue super, which eventually lands in your employee's pocket. Now, beyond that, when you do have overdue super, again, use the $20,000 example for 1 quarter. If you don't put your hand up and admit it and lodge the SGC form, you could cop a penalty as high as 200% of the balance of that unpaid super. So you didn't pay 20 grand in super, bugger, made a mistake, prioritized buying a new car or, paying off some other bills in my accounts payable. Everyone's, the squeaky wheel gets the oil, cool. But that 20 grand in super you didn't pay could end up copping you a $40,000 penalty, other interest and admin charges on top, And then the 20 grand that you paid and the 40 grand in penalty, not tax deductible either. So it is just, you're getting hit. It's a double, triple whammy from all angles. That is why one of the number one things we will say to our clients is pay superannuation first. Move to weekly. Whenever you process payroll, click the auto super button and let the super get sucked out of your account, because it is not your money and is the one part that is the one parcel of money you don't want to keep and spend somewhere else, because those penalties and that interest and what you cop and no tax deduction, it's a recipe for, as I said, it's a reason it's a red flag. It's just sending your business straight into a direction you do not want to go.
Super is something that people often forget about. Even myself, when I get the phone call from the accountant saying, "Hey, we're going to pay the super this quarter." Oh yeah, shit, that's right. So it's just creating habits to understand what your liabilities are, right? And I think about our own policy in here. We've got a set amount of expenses that we need to retain at all time, and it's not 3 months for us, to be transparent. It's actually less than that, because we've got a recurring revenue stream. So we've got a really good read on our revenues almost sort of 3 to 4 months out. But when we look at the minimum amount we need to hold, we add to that what we've got due from a GST point of view, what we've got due from a PAYG tax point of view, and what we've got due from a superannuation point of view. And that's all on our balance sheet. So I go minimum expenses that needs to be held, plus we're going to owe that to the ATO, because it's not due yet, but it's going to be due in the next month. Plus, we're going to owe that for super. Plus, we owe that for all our payables, for all our creditors. And we need to keep that minimum balance. And anything above that on a quarterly basis, we're then happy to distribute as dividends. But it's having that methodology that we look at every quarter and go, add all those up. If there's not any more than that, you don't take any money out of the business.
And Jace, are they bringing the super payment requirement in, because it's once a quarter now? I know they were looking to do that. When is that changing? Do we know?
1 July 2026.
Yep.
You will owe super within 7 days of the pay run.
Oh right,
so,
okay, 7 days.
You pay on a Tuesday. By the following Tuesday, superannuation must be paid in the account. So essentially, it's payday super.
It'll resolve the problem, won't it? Unless there's no money.
Yeah, correct. It resolves the problem, but it creates some additional ones from a compliance point of view. Sometimes super can take up to 10 days to debit your bank account, a couple of days in limbo to hit the clearinghouse, a couple of days in limbo to hit the super fund, and then a couple of days for the super fund to book it into each of the employees' accounts. So there's a compliance issue where a year from now, it's mid 2025. By mid 2026, when payday super's in, all these clearinghouses and super funds need to make sure it is snappy and fast to move that money around. We've got Osco. I could send Nick $1,000 now and he could refresh his account. It's there. The same thing's going to need to happen with superannuation. When that debits out of your account, you need it to hit the auto clearing and the super fund fast to beat that 7-day period. So what I would say, thank you, Nick. It's done. Send that right now. So for those at home, get to YouTube. Nick just held up his BSB and account number. Start sending him money. No worries, he's desperate. The one hot tip I will say: start this practice now. Like, pretend that it's payday supers here already. Start paying weekly, fortnightly, monthly at a bare minimum. Don't get in this old habit of paying quarterly and keeping that money on standby. Start the habit now of getting the money direct debited every time a payroll is processed. Then when it rolls around to 1 July 2026, which blinking it'll be here, you're already in the habit. You're never going to get caught up with this no tax deduction or super guarantee charge form or 200% penalties. You don't want to be in that state. And this is why, look, if your accountant has said to you, like, not paying super is hectic, please make sure you pay super on time. Now you know why the accountants around the country go mad for this stuff. Financial red flag number 3. You are lodging your BASs and tax returns late. You're not getting your information sorted. You're in the dark. You're behind. You're dealing with historic information. You've been reached out to potentially by your accountant, or you haven't engaged a good accountant and you're kind of trying to do it yourself. If you are lodging your BASs and tax returns late, it is literally like waving, a flag to the ATO to say, come and look at me. I don't have good practices in place to keep things in order. So generally what happens when your BASs are late and your tax returns are late, it means your bookkeeping's not up to date. You don't have a bookkeeper, or your bookkeeping's not up to date. That's something else that goes hand in hand. If your bookkeeping's not up to date, how are you staying on top of your figures when you run your profit and loss or your balance sheet to get an understanding if you're making money or not?
Jace, I must confess,
Yes, mate.
I'm a culprit here.
Yep.
And the reason I wanted to bring this up is because I think, judging by the letter I saw the other day, the ramifications are increasing.
Yep.
So I have a property that's owned in a commercial entity. That's a commercial property owned in an entity. So it's not my business. We're all up to date. But I just forget about it all the time because it's just a rental property, but I've got to lodge a BAS statement for it. And there's times where I just forget it because it's minimal. It's not part of the business. Last one, I was late and I got a letter and I can't remember what it said, but I remember reading it the other day and I was like, holy shit, that's a significant fine. Whereas it used to be like, $100 or something. I was like,
yeah, I think
whatever.
close to $1,500 for an overdue BAS.
It was in the thousands. Yeah.
Yep.
Yeah, I need to get my act together on that property BAS statement. But yeah, I think this is what the ATO does, right? We've seen it over and over again, particularly of late. You talked about the superannuation, what happens if you don't pay that now, what you could be up for. ATO tax debt now, not tax deductible.
Yep, the interest.
Bigger fines for not lodging BAS statements. So it's clear that the ATO are just going to keep piling on bigger ramifications to get people in order.
Yeah, and think about it. If you're a profit centre like the ATO, they're a government department that needs to generate revenue and bring in revenue for the government. If they're sitting on a debt book of 110 plus billion, and let's say they can't collect all of that from a lot of the businesses that I said are insolvent or in liquidation. Do you know who they can collect that off? By fining and sending penalties and charging interest to the good businesses that have just not lodged on time, to the good businesses making money with poor practices. They're the ones that are going to financially suffer to make whole the government for the ones that now no longer have the money to do that. So if you are in limbo land, you're not quite the insolvent business that can't afford to pay its bills, but you're a business that is not doing the practices that need to be done, like keeping on up to date, lodging things on time, paying on time. You're going to become the one that pays back the government the additional in fines, interest, penalties to make the government as whole as possible. So that BAS return and tax return late, not only the penalties that you're getting, Nick, is definitely one thing, and great to bring that up. The other thing that happens there is when you lodge a BAS late, the GST and pay-as-you-go, because the BAS is late, can now become a director penalty notice to the director. So if you'd signed and lodged that on time, prepare it, sign, lodge it on time, even if you can't pay it on time. But what happens is if you go, and I've had this conversation, almost weekly, call it monthly, with clients going, Jace, I got the BAS from you, but I didn't sign it because I can't pay it yet. And I'm like, no. If we've sent it to you, sign it and get it lodged, because whether you can pay it or not, the ATO needs to book it as lodged on time. That gives you a green flag that you've done the bit right, where you've got your shit together, you've got your books together, you've lodged on time. Now, the fact that you can't pay, then you get on the front foot, you call them and you communicate and do a deal. The ones who don't lodge on time, the GST and the pay-as-you-go withholding can become a director penalty notice. The ATO can basically trigger a letter to you personally, the director, and say, this debt is now your debt. If you can't resolve it within 21 days, you now need to trigger one of these events. And it's pay the debt in full, do a small business restructure, liquidate your business. And that is why now we've got this big bulk of liquidations and SBR events and insolvency events, because the ATO are getting serious. They're going, you know what? If that company goes into liquidation, we're probably not going to see much. But if we direct a penalty notice to the director, we're going to force action. So that is why late BASs and late tax returns, late BASs especially, are a problem. Sign them, get them lodged on time, get your books in order. Otherwise, you can see where the red flag's going and it's all bad.
Jace, what practices do your clients do that are very good that you see from a client initiative? Like, do you see clients that go end of month, there's always the income and the expenses coming in and you're ready to go? What's best practice that you see in business? Because we've all made those mistakes over time, and I guarantee there might be some good ones out there.
Yeah, good question. The basics are a separate bank account and just knowing an amount per week, per month, per invoice to carve out to a separate bank account. So you've always got the view of that money's not my money. It's a separate account and you know that money's not your money. That's one of them. The other good practice is GST, pay-as-you-go, super payable, income tax payable. They're all tagged on the accounts watch list. So when you log into Xero, in the top right-hand corner, it is all of your liabilities, like your main liabilities, ATO, superannuation, GST, pay-as-you-go. They're built in the top right-hand corner of the dashboard. So you can quickly sum them up and say, I've got that amount of money on standby. Or if you don't, you know that you've got less cash than what your ATO liabilities are in the top right-hand corner. And then beyond that, the next kind of step in that is the ones that have like the robust cash flow forecast in a live sheet, like an Excel live sheet or a Google sheet, or a reporting software like Float, Sift, different apps like that. Those ones are obviously the top of the tier.
Yeah.
We work with them monthly. We update the figures, but at a bare minimum, separate bank account and a dashboard watch list of your liabilities.
And what about if you're in your first year and a half in business? Just some good basic principles. Should they be looking at their expense and revenues once a month and just being proactive with it in real time, or once a quarter? What would you suggest from what you've seen?
Look, I'd love it to be once a month. I remember starting the business with Greg, and because then you're your own bookkeeper, you're wearing extra hats. If you don't have the budget on day one or month one or year one to be the bookkeeper, I think, Nick, you've talked about doing the bookkeeping yourself as well back in the early days.
I've been there.
But, like reconciling myself so that I knew the money in and I knew the money out, which meant that when I run the P&L, I viewed it as often as I could to become obsessed with the numbers, because I knew the numbers I wanted to grow to. I knew the inputs and outputs that would drive success. And so in the early days of being the bookkeeper and, using my own time, energy, resources, effort to do that in the early days, I knew it wasn't a forever thing, but it just meant that I was putting good habits in place of understanding my numbers early. So yeah, we love any small business owner that starts. If they don't have the budget for a bookkeeper day one, you got to find a way pretty quick to create that budget, because it's money well spent, so that it allows you to grow your business in other areas. But yeah,
I think what happens too, and we've been a culprit here, and there's something Marty says that resonates, is death by 1,000 paper cuts. And when you become a bigger business like ours, all of a sudden there's a lot of stuff going on. There's IT accounts, there's laptops floating around, there's phones, there's subscriptions, there's this, there's that. So when I think when people do budgets, they quite often focus on what are the big things: revenue in, employee costs, rent, things like this. But what I've learned over the years is just the amount of little things that could compile that you say yes to. Oh yeah, we'll do that event. Yep, we'll come here. We'll do that. Yes, someone can go to Brisbane. So if you don't actually look at that, so we look at that now every month and say, right, what did we spend last month? What did we keep? What didn't we keep? Does that then impact what we spend next month? So hypothetically, if we've got a travel budget of $3,000 a month, if we spent $6,000 last month, we're not spending anything next month. So it's those little habits that I've learnt the hard way, of saying, geez, we had a really good year money-wise, but geez, look at all these little costs that just added up. And, they adding up, they can be a game changer, but they can also, not added up, be easily lost in everything else that's going on. So for us, it's every month. We've got the budget built out in Xero, as you can build out your budget. So we compare the budget to the actual. So we compare the budgeted spend to the actual spend, look at the gap and say, right, was the budget wrong? Yes or no? If that's a legitimate spend, we need to adjust the budget moving forward. If the spend was wrong, why did we overspend? We shouldn't have got invoiced for that. Or again, as I said, we spent too much on travel. So no one's traveling next month. It has to be the month after. So Xero is such a cool tool. And it's not about being a tight ass. It's responsibility, because if you don't have that stuff sorted, then you can not have the money to pay things like super and the ATO.
Yeah, and that right there is absolutely sage advice for any business owner. That death by 1,000 paper cuts, the hole in the bucket, as I call it, those little problems that sometimes go miss can compound into massive problems. And it's also opportunity cost. Again, if you lean on that stuff, and it's not to skimp, it's to go, all right, what are the qualities around those efficiencies in order to then put that capital back into more income producing activities. So it goes the other way too. Once you're doing what Nick's doing, then you can optimize that in a more productive way in the business. Very powerful. Hey, very powerful.
Unreal. If you haven't looked into budgets in Xero to compare actual versus budget, Nick's story just then was exactly why that's the next step in your journey of what you can look into to, have financial empowerment, really. And those decision making, it's so much easier to make a decision on whether the number was right or wrong when you're matching it back to what you'd pre-agreed or what was mapped. You can see when something blows out. We had a client that had a budget for insurance of like $4,000 a month, and all of a sudden there was a month where it blew out, and the conversation then went, hey, what happened here? What was that? Oh, this vehicle, something happened, and I realized it wasn't insured, so I had to insure it. So you can then drive conversations around why there is variances and whether it was a spend that you could approve or a spend that wasn't approved. We had someone that bought a corporate box for a concert, and it was like, well, hang on a minute, that blew the entertainment budget for the year. That wasn't necessarily agreed. Maybe we need to talk about the cash flow of that. So
that's your big ticket stuff, though. But let's say those smaller little leakages, over the course of a year is 10% of revenue. Right, it's $1,000 here, $500 there. It's all the stuff you sign off on quick, and it's like, and all of a sudden you go, holy crap! Once you, but you got to identify the problems, and like Nick was saying, once you do that, you get a clear runway forward.
Absolutely. This app is unreal. I mean, I could talk about this accounting stuff for ages. I'm glad you boys are jumping in on it too. Quick one, this one. It leads in, if your BASs and tax returns are late, red flag number 4, financial red flag, you're spending your GST and your pay-as-you-go withholding and your tax savings. Your business might be profitable, or you're paying employees, which means there's pay-as-you-go withholding. It's not your money. You're making sales, you're collecting 10% GST, not your money. And then maybe there's some profit, 25% of whatever profit, not your money. Now, when that money's gone, that is money that wasn't yours, and then trying to claw that back and catch that back up is such a mission for a small business owner to try and recoup that money that they've spent that was never theirs to spend in the first place. It means the following month or the following quarter, you basically got to double down on how much you should have saved to be able to save enough to pay the previous quarter's money that you spent. So we see this is that red flag that if there is not enough money to pay the BAS at the end of the quarter, we know that the money's been spent that wasn't theirs. The client is then overspending in areas they shouldn't be. And again, if this flows into a BAS lodgement being late, all of a sudden director penalty notices, there's just a flow on of big problems when you're spending money that's not yours.
And I think you'll see with what Jace is saying, more revenue doesn't solve that problem. And this is the thing business owners don't understand. We always go, I've done it myself, we go, just get more revenue, it'll resolve itself. No, it won't if that's the behaviour. So what you're saying there is, again, just making that foundation really clean to be able to scale, profitability and good behaviours overall. So sage advice.
This can sometimes go hand in hand into financial red flag number 5, but sometimes not. Owners treating the bank account like their own money without Div 7A drawdowns or director loans. So, let's say there is a chunk of money in the business bank account, whether the company tax has been paid on that or not, the money gets taken out, director spends it on something. And then when we're having the conversation saying, hey, either you pay back that director loan, or if you can't, here's the personal top-up tax you're going to pay. No harm in buying nice things for yourself, but you got to make sure that it doesn't become a financial red flag for your business because the business has tax bills to pay. Div 7A loans, year-on-year loans. So sometimes you can go, cool, the 2024 financials, there was an amount withdrawn by the director. They didn't manage to repay it all. Then you get to the end of 2025, you've set up a director loan 2025. All of a sudden there's 2 balances. 24 has become an official loan with a repayment. 25 started. You just see the writing on the wall when there's money being drawn from a company before the company's had enough profit to pay tax and declare a dividend, or when it's been overdrawn and it means that the ATO hasn't been paid in full, or there's not enough money to pay the future tax bill and that money will be back later. Director loans and Div 7A loans, not always a financial red flag, but often, unless they're managed properly and put into the right structure and the right loan agreements and the right repayment schedule, can very quickly become an issue for a small business owner.
Yeah, and I think people sometimes misconstrue when we talk about this stuff that we're almost being too defensive rather than the more aggressive side in business. But all great games are built off a great defence. Like all premierships in footy build off defence first as a foundation piece to scoring heavily, right? And having good systems in play. And I think once you, and the biggest pain point in business is people not addressing these things. And once they have and the foundation's set, mate, you can fly beyond your wildest expectations. And that's really the setup. So what we're talking about here is vital, not only for survival, but to create a great foundation to launch from in the future as business owners.
Yeah, and Marty, you say defensive, but I would say it's not defensive. And the whole reason is this is money that you need to keep your business in operation. So if you are earning a certain amount of money, a certain amount of that's got to go to the ATO. If you pull money out of your business, a certain amount of that's got to go to the ATO. So there's no point you investing money in your business to grow if you haven't got in the bank account what you need to keep the doors open, because then all the money you've invested is pointless anyway. So it's just understanding that if I've got this much money in the bank account, what do I need to go to super? What do I need to go to the ATO? Then you can identify what you actually have left to invest and then continue to grow your business. Because the reality is, if you don't do that and you use the money that you were going to use, or that was required for super and the ATO to grow your business because you back yourself, well, that's great. But what if you back yourself but it doesn't work? What if it's completely out of your hands and something doesn't work? That liability doesn't disappear. So it's, you say defensive, which I totally agree. Some people might see this as defensive, but for me, it's just being aware.
Yeah.
It's being aware of what your current situation is, not that's how much money is in the business account. Now, how much money do I actually have left to invest or to draw out?
Yeah.
And then if I do that, what are the ramifications?
Corporate responsibility, you're right, Nick, and it's not sexy, but it's important.
And look, the other thing with the Div 7A loan that's the kind of elephant in the room is if it's not managed properly and you get audited by the ATO, it becomes an unfranked dividend. Whether you've got franking credits in the company or not, whether you've prepaid some tax, if you meet the requirements of a structured loan agreement and a minimum repayment by a certain due date per the loan agreement, or there's no loan agreement in place, that becomes an unfranked dividend and you pay top marginal rate of tax as the individual director who took that money. So that's more the point of like managing it properly is the big thing. Having the conversation with your advisor, making sure it's done properly so that the ATO doesn't get extra tax that they're not entitled to.
Yeah, and there's absolutely nothing wrong with Div 7A loans. I've got 100%. one. I've got one in full transparency, but I know what that means, and I chose to go that way. But I know what my responsibilities are with it. So, again, it's not to repeat myself, but this isn't about defense. It's about awareness of every decision that you make, and what happens on the back end of that, and what your responsibility is because you made that decision.
Yeah, 100%. This one heading into the 25-26 year is a big one. Some big changes from the ATO that you need to be aware of is that interest on an ATO payment plan or interest paid to the ATO is no longer tax deductible from 1 July 2025. That's the GIC, the general interest charges from the ATO. So let's say you've got a payment plan. Let's say you put a couple of $100,000 or whatever the amount is on a payment plan for your small business with the ATO. And every time the ATO charges you interest each month, your accountant or your bookkeeper is booking the interest as an expense in the P&L and adding the balance to what you owe on the balance sheet to the ATO. Now, in the past, that's been tax deductible interest. The current rate is around 11.17%, give or take. Probably picked a random number, but it should be about that for last quarter, which meant that 11% interest you're paying to the ATO is tax deductible. 1 July 25 onwards, not tax deductible, which means, on a debt like $70,000 to the ATO over 2 years, you're looking at $8,250 in general interest charges, looking at paying about $3,500 per month. Now, if that interest is non-deductible, the cost to you is actually more than the $8,250 because that gets added back at tax time and you'll pay another 25% as long as you're a company. What you may want to compare to now is getting in the room with a good broker, know a few from our good friends here at Innovate, and weighing up your options to go, am I actually able to pay back my ATO debt within 2 years? Am I comfortable with not getting a tax deduction for that interest I'm paying? Maybe I can get a better interest rate anyway. Maybe I can get 8 or 9% in a business loan over 5 years, that that interest is going to be tax deductible. And all of a sudden my cash flow is $1,450 a month instead of $3,500, give or take, a month. So you got more cash to reinvest back in the business to grow, to be sustainable. So big one there, financial red flag number 6. If you're constantly got ATO payment plans, that is the red flag. Right now, though, the bigger red flag is that your interest is not tax deductible. So look at potential restructuring the debt that you have on your books. If it's with the ATO, no longer good debt, never good debt.
Nick, what do you think on that? If someone's got that type of tax debt, are they better to tie it into a commercial property to try and get a lower rate and make it tax deductible, or would you keep that separate in something more like an unsecured facility at a higher rate? I know it's dependent on the client, but what's your thought process in what would be optimal?
Look, it's very client dependent for sure. First thing is, do they even have the security? That's the first thing. A lot of people don't, even if they do have this security, a lot of people don't want to go down that path because they don't want to tie up the asset.
Yeah.
Which makes me laugh sometimes, because I'm like, just because they don't have security over your asset doesn't mean you're in the clear. Like, a lot of people have that mentality, and I completely get that from an asset protection point of view. But I guarantee if you don't pay the bank back, they'll find a way to get the money if you've got assets. So you can get unsecured at about 9%. To Jace's point, you could secure it against a residential property at probably about 5.5%, 6%, if it was interest only. So I would definitely, for me, it's unsecured, and I'm happy to pay the extra because I would rather keep the assets to build more assets, equity for other things. Yep. So, but then I think there's also the question of, can you get the finance? First thing bank's going to say is, why do you have a tax debt? How are you running your business? So they're obviously lending you the money to take the ATO out. So what we are seeing though, Marty, is banks are becoming more open to paying down tax debt or paying out tax debt, because they know that there's going to be an opportunity because of this recent change with the ATO interest not being tax deductible. So if we're putting it to a bank, we've just got to put a good story around it. Why they have tax debt, what do the future cash flows of the business look like, and whatnot. But if it's secured, it's obviously easier because they've got something to get their money back pretty quickly.
No, I love it. And thank you for the input, Nick. So the final one, and we'll round it out here and wrap it up. You have listened to me for a little bit longer than some of our eps, but I'm just passionate about these red flags that we're seeing. I'm sick of seeing good, hardworking small business owners doing it tough and going under. So these are the things you got to look for. The final one here, the financial red flag. Marty, you kind of alluded to it right back at the start of the episode. It's a business owner that has no understanding of their break-even point. So by not understanding their break-even point, they don't know how much revenue they need to generate to then be able to be profitable. So you're making sales, but you got no idea, if you're going to have enough to be break-even at the end of the month. Month in, month out, with a few clients that we're meeting with, we're seeing the bottom line being in the red. And the question is then, I thought I was bringing in enough money to beat all my expenses. So these conversations, unfortunately, can happen, and they're common. The small business owners, you need to understand your break-even point. You need to know what you need to bring in month to month, week to week, day to day to be profitable. And that is what being in business is all about. You need to make money. Otherwise, there is no point doing it. If you continue to invest in a business that isn't making money, all these red flags start to appear, all these financial red flags appear, and you start to do it really tough. And then you become a statistic. You add to the ATO's $111+ billion debt, and your business is gone.
It's a really great point. I think that people that have businesses that produce products, it's a little bit more complicated on the cost of goods in regards to manufacturing the product to get to that break even on top of the expenses, particularly when they first start. In services, we sort of know what the remaining income is going to be after wages and costs. But that product production is another element that sometimes business owners come unstuck. Like, they basically sometimes have to be generating twice what they're thinking just to cover their break even point. So that's a good one to run through those numbers, know where you stand, know your exact numbers and what your minimum that you have to hit as a survival point.
Yeah, 100%. And we've had conversations with manufacturing clients that are like, well, if I put my prices up, I won't manufacture as many items. But then it's like, well, if you're doing the items at break even or losing money on them, you shouldn't manufacture that many anyway. Let's pull it back and make sure we understand. So appreciate the time listening to this episode. We appreciate all of our audience, all our listeners, and all the support we do get here at The Numbers Game. Thank you for tuning in and listening. Please go and rate, give us your reviews, send us emails, or contact Jace, Nick, or Marty, LinkedIn, Instagram. We're around. Not sure about this TikTok business, but I've heard we're on there as well now. So go and check out TikTok if you haven't been over there before. Until next time, though, if you do notice any of these financial red flags, take it seriously. They're sometimes not just admin slip-ups. They're indicators that your business could be heading for a bit of pain. So reach out and talk to us, or talk to your advisor, talk to someone who can help you out here, because we don't want to see you become a statistic. And until next time,
sometimes you got to address the red to go to green. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.